So I didn't memorize my presentation, but so I have to make notes, right? So I didn't bring my glasses, so the notes I have to be written on like 20 point, right? So just so I could read them. If I held them up, I joked to Paul, he could probably read them from there. But here we are. So I went through the three meetings. They had a meeting on October 17, January 18, and June 18. And I kind of sifted through the topics and organized them into a variety of areas, right? There we go. Okay, so most of the topics were on the three big issues. IFRS 16, IFRS 9, and IFRS 15. You would expect that, right? Uh-oh, what happened? Oh, I'm stepping on something. Okay. Most of them on leases, financial instruments, and revenue. These are good because they provide examples you can learn from, right? So some of the other topics touched, too, are on cannabis, cryptocurrencies, and other stuff. Anyway, so I'm not going to go over the other two issues, but I'll touch on the cannabis and the crypto, too. But I'll summarize what the discussion was for you, right? Okay. Here are some of the issues on leases, right? Starting out with cloud computing arrangements, right? Cloud computing arrangements are fees paid to suppliers to access the supplier's hardware and application software. Everyone knows what the cloud is by now, I'm sure. So there was group discussion on if these costs are within the scope of IFRS 16 leases or IAS 38 intangibles. And if they're not within the scope of that, then the costs are expensed. So if you have one of these arrangements, you have to look at it, see it could be within scope. These issues were also discussed at the IFRS Interpretations Committee meeting in September 2018. Dan's in the audience here. It's like I'm presenting in front of my teacher, right? Because she put this stuff in front of us a little bit earlier. So the conclusion was, of course, after this discussion was that there's no additional guidance that's going to be issued. The accounting depends on the specific facts and the circumstances. So if you have one of these arrangements, read the discussion and it could fall within scope. That's the point of that. All right. Another issue, fixed payments and variable lease payments. So this is a discussion on how to distinguish between in substance fixed payments, variable lease payments linked to an index or rate, and variable lease payments linked to future performance, and consider the accounting implications of each. So the example that they had in there was from a mining company. A mining company that is about to go into commercial production, enters into a contract to purchase some equipment. So of course the contract to use the equipment was a small fixed payment and then a variable payment based on production, right? So the variable payment, how is that included in the cost of the lease or not? So that's the example. Discussion was had. It's useful to read it. It's for a mining company too. So if these examples apply to you, it's very useful. The next one, future lease payments, right? So this one considers whether factors outside management's control could affect whether an entity is reasonably certain to exercise a renewal option. In the example, the factor they used that was outside of management's control was board approval. So you have a lease with one term, and then they can renew the lease for a second term, but it's subject to board approval. Does the board approval is outside of management's control because it's the board. So then is that an extra lease term included in the term of the lease or not? Right? So that's what they debate. And they also discuss how to measure the lease liability if future lease payments upon renewal are not known till a later date. Okay, so in this example, then you have a one term and you have a second term where it's likely they're going to exercise the second term, but the price isn't specified. So how do you capitalize that as a right to use asset? Well, they go over into how you would, the other ways you could possibly capitalize even though the price isn't specified, right? So, all right. Leasee's discount rate, that's another component of the leasing standard. It's funny how, in my view anyway, that the leasing standard, the revenue standard, and the financial instruments was debated for 2 years, 3 years, internationally, US, Canada, right? Yet, not all the issues were covered. I mean, there's all these questions that are left over that nobody thought of or they weren't. So it's confusing. It's a confusing area, and these examples are useful, right? So Leasee's discount rate. This considers how to determine the leasee's incremental borrowing rate at the date of initial application and in situations where the implicit interest rate is not known. And they also discuss the discount rate the leasee should use when it exercises a renewal option not previously included in the determination of a lease. The leasee's discount rate should be the incremental rate included in the lease, but if you don't know that, then you have to use your incremental rate of borrowing. So this discusses that issue, right? Lease incentives, right? Okay, so on the other example there, I had a for lease sign, and this slide I took a picture of a for rent. I was at another presentation, and when companies implement this standard, as Guy was saying, that it takes a lot of effort, especially if you have a large organization. So you have to go through all your locations and gather the information. So you go to them and say, could you please send me all your leases, right? So the guy gets all the leases, they put them all together. That can't be it. That can't be all of it. So he asks again, could you please send me all your leases? I have to do analysis of them to see if they should be capitalized or not. And then he goes through, what about all these payments here? What about all these payments? Oh no, that's not a lease. That's for rent, right? No. That's probably included in the standard too, right? So just because it says rental contract doesn't mean that it's not included in the lease standard. So lease incentives, all right. Consider the interplay between, oh yes, this is where there's an apparent inconsistency in the wording of the standard itself. Right? The interplay between paragraph 24b of IFRS 16 and illustration example 13. See if I could just say what the inconsistency is. So paragraph 24b of IFRS 16 states that the cost of the right of use asset shall comprise any lease payment made at or before the commencement date, less any lease incentives received. Makes sense. What you pay, less what you receive. Okay. Example 13 states in part, this one in part, the leasee accounts for the reimbursement of leasehold improvements from leaseor applying other relevant standards and not as lease incentives applying IFRS 16. Okay. And then this says, this is because costs incurred on leasehold improvements by a leasee are not included within the cost of the right of use asset. But wait a minute, the paragraph in 24b says they are. So that's the apparent inconsistency. Is that right, Diane? Okay, so they debated this thing for 3 years, yet that seems to be an inconsistency. Weak argument saying, well, it's only an example. It's not really the standard. I don't know. So it seems to be kind of cute almost. All right, lease term. Questions on the lease term. So this one considers what constitutes reasonably certain when determining the lease term, because you include it in the lease term if it's reasonably certain you're going to exercise the extension, right? And discuss when a significant event or significant change in circumstances has occurred that will result in a reassessment of a leased option. So there are 5 examples that are 5 fact patterns that they go over, and they discuss the implications of each one of those. And then the question on easements, and this is the question I brought up to Diane too when we were talking about it internally, right? I said, well, what happens, Diane, when, because we've seen it, where someone has to pay, like a company, a mining company, has to pay the landowner to access their land, so they can do drilling or anything, right? So she goes, that's an easement, right? So easements, now that's an issue discussed in the IFRS discussion group because it may or may not be a lease, right? So this one considers the accounting for a right granted by a regulatory authority to construct above or below privately owned land. Now they use a pipeline as an example, right? You have a right to access the land while you're building the pipeline, but I've seen it in exploration companies too. So that could possibly be a lease. All right, that's the IFRS discussion room on leasing. Then we get to financial instruments. I read these. After I read those, I felt like I had one of those things through my head, right? So this is a very complicated area, right? Okay. First one, modification or exchanges of fixed rate and floating rate financial instruments. I'm just going to rip through these. So this discusses the accounting for recognition of fixed rate and floating rate debt with prepayment features and fees and costs incurred in relation to the modifications, if you modify something. So the approach taken impacts the amount of gain or loss and impacts what you do with the transaction fee. So if you have a modification, it's got to be reviewed, and you could take a couple of approaches, right? So the second one, lifetime expected credit losses for trade receivables. Guy brought that up too. Of course, it's more of an issue for an operating company with trade receivables when you sell something and you have receivables from customers, right? So this one discusses how to measure the lifetime expected credit losses for trade receivables, including considering what are appropriate forward-looking factors. And the group discussed 8 questions relating to this issue, right? Okay. There we go. Modifications or exchanges of financial liabilities, another subject that do not result in derecognition. Further to the group's discussion in May. Now, I'll read this, but this is very, very technical. Considering when the non-authoritative guidance in paragraphs BC 4.252 to BC 4.253 and the basis for conclusion should be applied and how they relate to debt instruments and interest rates. Complicated. Okay. Own use contracts. Own use contracts. Now, again, I'm almost like I'm debating with Diane here, but own use contracts is a very important area because it gets you out of being a derivative, right? So you can use the own use exemption to get out of scope of IFRS 9, and then you account for it not as a derivative. And derivatives, put it professionally, require a lot of judgment and estimation in order to calculate the amount of the potential liability, right? To put it not simply, they suck, right? Because it's hard to do. So we have to get other experts to help us out. So if you conclude that it's an own use contract, you can get out of the derivative liability. And this discusses the application of the scope of the exception in IFRS 9 relating to contracts that are entered into for an entity's own use. Now, could come into play with streaming arrangements, for example. Right, so streaming arrangements have, there's the IFRS discussion viewpoint that has PDIC viewpoint that has 3 possible alternatives, right? Sale of part of the asset, deferred revenue, or a derivative, right? So if you get out of being a derivative, which is very hard to value, by using the own use exemption, and then pushes you into deferred revenue, which is much easier to value, right? So this discusses what the factors to consider when using an own use contract. And the last one there, classification of financial assets, discusses the aspects of the application of IFRS 9 to financial assets when varying features in different scenario. For example, payments with priority and retraction features. All right. Revenue. Again, not a huge issue with some of the companies that we deal with, but it'd be surprising where it would pop up. And this is with the first one here, right? Sale of a non-financial asset involving a royalty interest. So it considers the scope and accounting for a sale of a non-financial asset that involved granting of a royalty interest. For example, the example they use is a mining company where it sells a property off that can go into production, and they keep a 2% royalty on it, right? So the question is the 2% royalty, does it have an impact? Is it under IFRS 15? Is it revenue? So to consider, and I can see that happening. Changes to transaction price. So this one discusses the application of paragraph 88 on how to allocate changes in transaction price attributable to variable consideration. IFRS 15 doesn't have a lot to do with resource issuers like I mentioned, but it's most to do with high tech or software, right? And the example they use in this one is a contract to sell 2 intellectual property licenses and some considerations there. Another one discussion was a significant financial component. Consider the accounting for a significant finance component in a revenue contract when there's a change in the timing of transfer of the promised goods or services to the customer. All right, so that's the revenue discussion points. Cryptocurrencies. Now, this one's come a long way. So the first meeting was in January of 2018, and they just said that, well, there's some issues out there, right? That's January 2018. Think how far we've come now with all the discussion papers and points that have been out there. There's not going to be any additional guidance that are issued. So this is where we're getting our guidance from. Meetings like this and put out by the CPA, and then internationally they discussed it too. So they discussed it again, I think it was in September 2018, like I mentioned, right? Where they discussed the accounting for transaction fees on a miner. So specifically to mining activities, right? They discussed the accounting for transaction fees and the rewards for newly created cryptocurrencies earned from cryptocurrency mining activities. Also discussed the factors to consider in assessing whether there's an active market for a particular cryptocurrency. Now, I mentioned that the IFRS Interpretations Committee also went over this in September 2018. The IFRS discussion group is a local Canadian group. Then they push it up to the Accounting Standards Board, which, if they think it's warranted, push it up to the international bodies to possible put more guidance, because the Canadian can't put guidance internationally, but the international group can, of course. So the international group had a meeting on cryptocurrencies too. They had 4 papers in September. First paper was a lot of definitions, introduced the issue, right? But the second, and then they had another paper discussing the application of IFRSs to the standards as they are now, the existing IFRS that are available. Nothing really new there, not from my understanding. 16 pages though. It kind of reaffirms what we already know from the CPA, what they said. Then they go another agenda paper that provides information about prevalence of holding of cryptocurrencies, and asks the committee for advice about the usefulness of information provided by IFRS and related to the holdings of cryptocurrencies, possible standard setting activities. And then the fourth paper, which is analysis on the application of existing IFRS standards on ICOs. You know, cryptocurrency is kind of the wild west of accounting, maybe. You know, cannabis you can understand, it's hydroponic farming, but cryptocurrencies, it's kind of, you have to figure out what it is. ICOs is the wild west of the wild west of the, you know, of the cryptocurrency space. All right. Last topics, anyways. Oh yeah, there's the September meeting about cryptocurrencies. 4 papers. All right, cannabis. Yeah, notice I had a picture on every single other slide. I didn't feel like standing up here with a picture of cannabis over my right shoulder here, just in case border issues and all that kind of stuff. It's a funny subject. You know, we were just debating earlier, right? We're going to have drinks at the back of the room, but you know, no one thinks to have. Well, it's legal now. I don't know where we're going to cross that bridge. You know, that's okay. Cannabis accounting. Yeah, biologicals are here. So the recognition and determination of fair value. They had a. There we go. Whoops, did I go past it? There we go. Recognition and determination of fair value. Yeah. Now this one is done in June, of course, and it's before it came legal in Canada. But they talk about the legality in different jurisdictions, so it could be easily applied to the U.S. You know, to U.S. now. It says, considered whether uncertainty and restrictions in the legal environment that affects future sales of an agricultural produce, for example, legalization of cannabis, affects the ability for the agricultural produce to meet the definition of an asset. Also discusses possible methods to determine the reliable fair value of an agricultural product that does not have a commodity market. So if you're producing in one area and it's not legal there yet, right? For example, December 17 or something like that, if you're doing historical financials, can you still have it as an asset? Or if you're producing it in this state, but you can use part of it somewhere else, which price do you use? You know, so it talks about those kind of issues when you're valuing or assessing your biological assets. All right. Oh, I keep thinking that it's the next slide, but it's not. Okay, cannabis accounting again. Costs incurred related to biological transformation. This is more or less presentation. So it discusses the accounting for costs incurred related to the biological transformation of biological assets. For example, growing cannabis that are measured using fair value models. So everyone, depending on which approach you take, if you take your costs that are actually incurred and put them onto the inventory line or put them onto the statement of operations line, the number comes out the same. The presentation is slightly different. So this debates the two ways of doing it, right? And same with the next one, right? Presentation. Consider the presentation of following items in the Statement of Comprehensive Income. For biological assets, it discusses the presentation of gains and losses arising from change in fair value less cost to sell. And for agricultural produce, discuss the presentation of amounts realized upon the sale of an inventory item. So it all amounts to the same money when you finally sell the item that you put to fair value, and then you expensed it, and then some of it was fair value last year and you have to expense that. So how does it all look in the end? Now there's some other guidance that was issued too by the CSA. I don't know whether Mike's going to bring it up here or not, but there's 2 CSA staff notices on cannabis as well. One of them was to just disclose the risks, right? That's the fact that it's illegal in the States, right? That's CSA Staff Notice 51352, and that's issues with U.S. marijuana-related activities. But there's a recent one that was issued in October 2018. It says staff review of reporting issuers in the cannabis industry and its presentation of things I just mentioned, right? How should you present it on your statement of operations?